Brookfield Asset Management 2025 Letter to Shareholders. Overview. We delivered strong earnings in the fourth quarter, further accelerating the momentum that has been building throughout 2025 and into 2026. We finished the year with earnings, capital raising, deployment, and monetizations at all-time highs. We raised $35 billion in the quarter, our strongest fundraising quarter ever, bringing the total for the year to $112 billion across more than 50 different funds in the market. Demand was broad-based across strategies and geographies, underscoring the durability of our franchise and the scope of our investment capabilities in today's environment. Combined with strong capital deployment of $13 billion in the quarter and $66 billion for the full year, our fee-bearing capital, FBC, base grew to $603 billion, up 12% over the last 12 months. We generated a record $867 million, or 53 cents per share, of fee-related earnings, FRE, and $767 million, or 47 cents per share, of distributable earnings, DE, in the fourth quarter, representing increases of 28% and 18% respectively over the prior year period. This brought FRE and DE for the full year to $3 billion, or $1.84 per share, and $2.7 billion, or $1.65 per share, respectively. Market environment and 2026 outlook. As we start 2026, global economic conditions remain strong, supporting a broadly constructive investment environment. Stabilized interest rates, resilient economic growth, tight credit spreads, and improved global M&A activity are contributing to confidence across markets. Capital from growing allocations and a widening spectrum of investors is increasingly gravitating toward real assets, where stable cash flows, inflation protection, and downside resilience are very attractive. These forces are driving deal activity across private markets and reinforcing the opportunity set of high-quality, long-duration assets that generate stable cash flows and attractive risk-adjusted returns. Powerful structural megatrends continue to drive long-term investment demand, and the same themes that have driven deployment in recent years will continue to drive investment for years to come. Digitalization is accelerating the need for data, connectivity, and AI infrastructure. Deglobalization is reshaping supply chains and increasing demand for localized, resilient industrial and logistics assets. Growing power demand remains a central global priority, requiring large investment to participate in the generational build-out of power generation and energy transition solutions to support sustainable growth. Together, these trends represent multi-trillion-dollar investment opportunities globally and support our deep investment pipeline. With these dynamics, disciplined and patient capital deployment remains critical. Our long-standing focus on investing in high-quality and critical assets and businesses that form the backbone of the global economy continues to guide our strategy. With this as a backdrop, a step change in growth is emerging across our infrastructure and private equity platforms. We enter 2026 with strong fundraising momentum, having recently launched the 7th vintage of our flagship private equity fund, and we're preparing to launch the 6th vintage of our flagship infrastructure fund. Similar to our recent power and real estate flagships, we expect both to represent our largest vintages ever. In infrastructure, we see significant growth opportunities. The upcoming launch of this next flagship will build on a strong performance and expanding opportunity set of prior vintages. At the same time, the recent launch of our AI infrastructure fund will anchor our $100 billion AI infrastructure program and is supported by founding partners NVIDIA and KIA. The build-out of AI infrastructure is one of the largest infrastructure investment cycles in history, driving unprecedented demand for power, data centers, compute infrastructure, and grid modernization. Given the concurrence of strong investor demand, the scale of the current opportunity set, and having all of our infrastructure funds in the market this year, infrastructure will be a significant contributor to our growth in 2026 and 2027. Within private equity, we are at a similar inflection point. The recent launch of our 7th flagship vintage addresses the strong client demand for large-scale, operations-oriented investments at this point in the cycle, while our complementary funds in the market, including our Financial Infrastructure Fund, Middle East Partners Fund, and recently launched private equity wealth vehicle, further extend our reach into market segments where operational hard work, capital intensity, and sector specialization create durable competitive advantages. Taken together, the breadth of these platforms, the depth of our operating capabilities, and the convergence of powerful secular tailwinds reinforce our confidence in the acceleration of growth across both infrastructure and private equity over the long term. At the same time, momentum continues to build across credit and private wealth. Within insurance, Brookfield Wealth Solutions, BWS, pending acquisition of Just Group will result in an expanded asset management mandate and accelerate organic growth in the UK for BWS. Within private wealth, our recent launch of both our private equity and asset-based finance funds represents an important step in the continued expansion of our private wealth platform. These strategies broaden access for individual investors to our private equity capabilities and support the long-term growth of our private wealth channel as we continue to build further durable, recurring sources of capital. We're also acquiring the remaining stake in Oaktree that we do not already own, which will enable us to enhance collaboration across our credit business and strengthen our ability to continue delivering long-term value for our clients. With constructive market conditions, more sources of funding than ever, and strengthening deal flow, we are well positioned to raise and deploy capital at scale and to deliver durable long-term value for our clients and partners. Taken together, these factors position us for one of the strongest years in our history. Reflecting these supportive tailwinds and our strong growth outlook for 2026 and beyond, we are pleased to announce that our board of directors approved a 15% increase in our dividend, representing $2.01 per share on an annualized basis. Diversification and resiliency of BAM's cash flows. Over the past decade, we have scaled our business to better serve our clients, expanding our capabilities to meet their demands, broadening the solutions we can offer, and increasing the scale at which we can invest. As the opportunity set for real assets and credit has expanded, we have meaningfully increased the number of strategies we offer and the breadth of clients we serve. At the center of this success is our disciplined investing approach. By taking a long-term intentional approach to broadening the platform, we have built a business that can raise capital more consistently and deliver an earnings profile that's more predictable, more resilient, and better positioned to grow across economic cycles. Today, essentially all of our distributable earnings are fee-related, the lowest risk and most stable form of earnings for our industry. Further, more than 95% of our fee-related revenues are generated from capital we manage on a long-term or perpetual basis, providing exceptional durability and visibility into future earnings. But the strength of our earnings model extends beyond capital duration. It is reinforced by the breadth of our platform and the diversification we have built across asset classes, products, clients, and geographies. This diversity provides multiple paths to deploy and capitalize in any market condition, ensuring that one segment or another is always growing rapidly while also supporting consistent performance across market environments. One of the most significant changes over the past decade has been the expansion of the types of assets we invest in. 10 years ago, we had our standalone infrastructure, private equity, and real estate businesses. Since that time, we have built new platforms in transition and credit, and in some cases, we've built organically. Transition was first incubated within infrastructure, but after separating it out as its own asset class and combined with our legacy as a leading renewable investor, it has grown into one of the largest global platforms with over $140 billion of assets under management. In other cases, we partnered and acquired complementary capabilities, most notably with Oaktree in 2019, along with additional partner managers since then, to create one of the largest and most comprehensive credit platforms in the industry. Importantly, no single business contributes more than 1/3 of our fee-related revenues. This balance matters. Different businesses respond differently across economic cycles, interest rate environments, and capital markets. By ensuring that no one area dominates our earnings base, we reduce reliance on any single asset class and continue to grow through a wide range of environments. We have also meaningfully broadened our product offerings. In 2016, we had 4 products in the market. This year, we'll be fundraising across nearly 60 funds and strategies. With more products in market at any given time, fundraising is now more diversified and consistent, enabling steadier inflows from quarter to quarter and aligning capital with opportunity as market conditions evolve, while serving clients with solutions tailored to their specific investment objectives. Client and channel diversification further reinforces stability. We now have relationships with more than 2,500 institutional clients globally, representing more than tenfold growth over the past decade. Alongside this institutional base, we can now also raise capital across other channels. Our private wealth platform today serves nearly 70,000 clients across multiple strategies and has become an increasingly recurring source of capital. Our insurance solutions business has grown from inception during the pandemic into a platform managing over $100 billion of fee-bearing capital on behalf of nearly 800,000 policyholders, providing long-duration capital that is well aligned with our investment horizons. Our public affiliates add another important dimension, providing permanent capital and a connection to public markets that complements private fundraising. This breadth is unmatched on a global basis and is a key differentiator of our business. Our platform is also truly global. We raise and deploy capital across more than 50 countries. This matters because economic, political, and market conditions rarely move in sync. Geographic diversification allows us to continue raising capital when certain investor groups are more cautious and shift deployment to regions with more attractive opportunity sets. Taken together, this diversification has produced what we set out to build, a stable, resilient earnings model designed to perform well in different market environments and grow across cycles. Looking ahead, individual investors, through private wealth, insurance, annuities, and retirement solutions, will represent an even larger or more balanced share of our capital formation over time. These are long-duration, repeat sources of capital that should further enhance earnings visibility, reduce cyclicality, and support durable long-term value creation for our shareholders. Private equity is evolving. Operators will lead the next chapter. Our private equity business was born out of our long-standing approach to owning and operating real assets that form the backbone of the global economy. For more than 4 decades, we have focused on acquiring and operating industrial and essential service businesses, companies that produce, move, and support the critical systems underpinning economic activity. Our owner-operator mindset distinguishes us and shapes how we invest, manage risk, and create value. Private equity has entered a new era focused on returns that are driven by margin expansion, not multiple expansion. Financial engineering is no longer a viable source of value creation as it now faces headwinds from normalized funding costs, slower monetizations, and buyers discounting forward growth. That shift plays directly to our strengths. Performance will no longer rely on rolling the dice on the broader market, but on rolling up sleeves and improving operational efficiency, an approach that has been core to our DNA. Half the value we've generated in our private equity investments has come from operational improvements, a real differentiator for our franchise and a consistent strategy to maximize value. A recent investment that illustrates our approach is Chemelex, the global leader in electric heat trace systems, mission-critical technology used across industrial facilities, energy infrastructure, data centers, and commercial real estate to ensure fluids, pipes, and equipment operate safely and reliably. While essential to operations, Chemelex products represent a small portion of customer costs, creating strong customer loyalty, recurring aftermarket revenues, and highly predictable cash flows. Despite its market leadership and decades-long track record of innovation, Chemelex was treated as a non-core division by prior owners, resulting in underinvestment and limited strategic focus. This created an opportunity for us to acquire a high-quality industrial business, an attractive entry point, exactly the type of situation where our operational expertise can drive value. Since acquiring the business, we have established Chemelex as an independent company, built out its leadership team and core functions, and implemented targeted operational initiatives. In 2025, we delivered over $20 million of EBITDA improvements through pricing, procurement, plant upgrades, and efficiency initiatives, driving over 15% growth year over year. Looking ahead, our value creation plan reflects our broader playbook, driving operational excellence, investing in end markets, and supporting continued innovation through R&D. The mission-critical and long-duration, recurring cash flow nature of our portfolio companies makes them inherently more resilient, easier to underwrite, and consistently attractive to investors seeking predictability and downside protection. As a result, even as many private equity managers have stepped back, we have remained active, raising capital, deploying into high-quality opportunities, and returning over $10 billion of capital to clients over the past 2 years. The macro environment is improving, deal activity is accelerating, and industrial businesses are being reshaped by 2 powerful forces: deglobalization and AI-enabled productivity. Supply chains are being rewired, manufacturing capabilities are being reevaluated, and companies are under pressure to modernize operations and adopt digital and AI tools at scale. This environment rewards operators capable of driving real change inside businesses rather than those reliant on leverage or market beta. The strengthening sentiment is also reflected in our listed entity's share price, which is up more than 50% over the last 12 months and contributed to performance fees in the quarter. Against this backdrop, we also launched the next vintage of our flagship private equity fund. This is an important milestone and a meaningful driver of future earnings growth, backed by a 25-year track record, among the strongest in the industry, and a strategy well aligned with current market conditions. We expect this to be our largest private equity fund to date. With operators defining the next chapter of private equity, our global, diversified, and operationally focused platform is built for this environment, positioning us to lead the next chapter of private equity and drive meaningful growth in the years ahead. Management succession. A message from Bruce. As part of a long-planned leadership transition, the Brookfield Asset Management Board today announced the appointment of Connor as CEO, effective immediately. I will continue as chair of the board for BAM, in addition to my role as CEO of Brookfield Corporation. Connor will continue in his role as CEO of our renewable energy business, supported by a deep bench of talent in that business. This appointment is the next step in our succession process we started 4 years ago, welcoming the generation of leaders who will guide the company for the next 20-plus years. It is firmly rooted in Brookfield's distinctive culture, which emphasizes collaboration, fosters innovation and entrepreneurial spirit, and maintains a strong sense of discipline. These core values will continue to shape the company's future, ensuring sustained growth and success under Connor's leadership. As I've said before, I have never been more excited about the prospects for our business than I am now. I intend to help in any way I can, focusing my energy where I can be most useful, and I will stay fully invested in Brookfield. Our entire senior team is thrilled to work with Connor as he assumes this role and takes Brookfield to new levels of success. Closing. We remain committed to being a world-class asset manager by investing our capital in high-quality assets that earn solid, attractive returns while emphasizing downside protection. The primary objective continues to be to generate increasing cash flows on a per-share basis and to distribute that cash to you by dividends or share repurchases. Thank you for your interest in Brookfield, and please do not hesitate to contact any of us should you have suggestions, questions, comments, or ideas you wish to share. Sincerely, Bruce Flatt, Chairman of the Board, Connor Teskey, Chief Executive Officer, February 4th, 2026.
Cautionary statement. Regarding forward-looking statements and information, all references to thous or dollars are to US dollars. This letter to shareholders contains forward-looking information within the meaning of Canadian provincial securities laws and forward-looking statements within the meaning of the U.S. Securities Act of 1933, the U.S. Securities Exchange Act of 1934, Safe Harbor provisions of the United States Private Securities Litigation Reform Act of 1995, and in any applicable Canadian securities regulations, collectively forward-looking statements. Forward-looking statements include statements that are predictive in nature, depend upon or refer to future results, events, or conditions, and include, but are not limited to, statements which reflect management's current estimates, beliefs, and assumptions regarding the operations, business, financial condition, expected financial results, performance, prospects, opportunities, priorities, targets, goals, ongoing objectives, strategies, capital management and outlook of Brookfield Corporation and its subsidiaries, as well as the outlook for North American and international economies for the current fiscal year and subsequent periods, and which in turn are based on our experience and perception of historical trends, current conditions, and expected future developments, as well as other factors management believes are appropriate in the circumstances. The estimates, beliefs, and assumptions of Brookfield Corporation are inherently subject to significant business, economic, competitive, and other uncertainties and contingencies regarding future events and as such are subject to change. Forward-looking statements are typically identified by words such as expect, anticipate, believe, foresee, could, estimate, goal, intend, plan, seek, strive, will, may, and should, and similar expressions. In particular, the forward-looking statements contained in this letter include statements referring to the impact of current market or economic conditions on our business, the future state of the economy or the securities market, The anticipated allocation and deployment of our capital, our liquidity and ability to access and raise capital, our fundraising targets, our target growth objectives, our target carried interest, and the impact of acquisitions and dispositions on our business. Although Brookfield Corporation believes that such forward-looking statements are based upon reasonable estimates, beliefs, and assumptions, actual results may differ materially from the forward-looking statements. Factors that could cause actual results to differ materially from those contemplated or implied by forward-looking statements include, but are not limited to: 1. Returns that are lower than target. 2. The impact or unanticipated impact of general economic, political, and market factors in the countries in which we do business. 3. The behavior of financial markets, including fluctuations in interest and foreign exchange rates and heightened inflationary pressures. 4. Global equity and capital markets and the availability of equity and debt financing and refinancing within these markets. 5. Strategic actions including acquisitions and dispositions, the ability to complete and effectively integrate acquisitions into existing operations, and the ability to attain expected benefits. 6. Changes in accounting policies and methods used to report financial condition, including uncertainties associated with critical accounting assumptions and estimates. 7. The ability to appropriately manage human capital. 8. The effect of applying future accounting changes. 9. Business competition. 1. Operational and reputational risks. 1. Technological change. 1. Changes in government regulation and legislation within the countries in which we operate. 1. Governmental investigations and sanctions. 1. Litigation. 1. Changes in tax laws. 1. Ability to collect amounts owed. 1. Catastrophic events, such as earthquakes, hurricanes, and epidemics, pandemics. 1. The possible impact of international conflicts and other developments, including terrorist acts and cyberterrorism. 1. The introduction, withdrawal, success, and timing of business initiatives and strategies. 2. The failure of effective disclosure controls and procedures and internal controls over financial reporting and other risks. 2. Health, safety, and environmental risks. 2. The maintenance of adequate insurance coverage. 2. The existence of information barriers between certain businesses within our asset management operations. 2. Risks specific to our business segments including asset management, wealth solutions, renewable power and transition, infrastructure, private equity, real estate and corporate activities. And 2. Factors detailed from time to time in our documents filed with the securities regulators in Canada and the United States. We caution that the foregoing list of important factors that may affect future results is not exhaustive, and other factors could also adversely affect future results. Readers are urged to consider these risks, as well as other uncertainties, factors, and assumptions carefully in evaluating the forward-looking statements, and are cautioned not to place undue reliance on such forward-looking statements, which are based only on information available to us as of the date of this letter or such other date specified herein. Except as required by law, Brookfield Corporation undertakes no obligation to publicly update or revise any forward-looking statements, whether written or oral, that may be as a result of new information, future performance is not indicative nor a guarantee of future results. There can be no assurance that comparable results will be achieved in the future, that future investments will be similar to historic investments discussed herein, that targeted returns, growth objectives, diversification or asset allocations will be met, or that an investment strategy or investment objectives will be achieved because of economic conditions, the availability of appropriate opportunities, or otherwise. Target returns and growth objectives set forth in this letter are for illustrative and informational purposes only, and have been presented based on various assumptions made by Brookfield Corporation in relation to the investment strategies being pursued, any of which may prove to be incorrect. There can be no assurance that targeted returns or growth objectives will be achieved. Due to various risks, uncertainties, and changes, including changes in economic, operational, political, or other circumstances, beyond Brookfield Corporation's control, the actual performance of the business could differ materially from the target returns and growth objectives set forth herein. In addition, industry experts may disagree with the assumptions used in presenting the target returns and growth objectives. No assurance, representation, or warranty is made by any person that the target returns or growth objectives will be achieved, and undue reliance should not be put on them. All references to asset monetizations include completed transactions and transactions in the process of being completed. When we speak about our wealth solutions business or Brookfield Wealth Solutions, we are referring to Brookfield's investments in this business that supported the acquisitions of its underlying operating subsidiaries. Cautionary statement regarding the use of non-IFRS measures. This letter to shareholders contains references to financial measures that are calculated and presented using methodologies other than in accordance with IFRS. These financial measures, which include distributable earnings, as defined below, its components and its per-share equivalent, should not be considered as the sole measure of our performance and should not be considered in isolation from, or as a substitute for, similar financial measures calculated in accordance with IFRS. We caution readers that these non-IFRS financial measures or other financial metrics are not standardized under IFRS and may differ from the financial measures or other financial metrics disclosed by other businesses, and as a result, may not be comparable to similar measures presented by other issuers and entities. We make reference to distributable earnings, which refers to the sum of distributable earnings from our asset management business, distributable operating earnings from our wealth solutions business, distributions received from our ownership of investments, realized carried interest and disposition gains from principal investments, net of preferred share dividends and equity-based compensation costs. We also make reference to distributable earnings before realizations, which refers to distributable earnings before realized carried interest and disposition gains from principal investments, and net operating income, which refers to the revenues from our operations less direct expenses before the impact of depreciation and amortization within our real estate business. Our outlook for growth in distributable earnings assumes growth in fee-related earnings and realized carried interest in line with our business plans, which assume growth in our fee-bearing capital consistent with our fundraising plans, capital deployment expectations, maintaining the fee rates we earn on fee-bearing capital, and earning margins consistent with our current margin. Actual results may vary materially and are subject to market conditions and other factors and risks set out above. For more information on non-IFRS measures and other financial metrics, see Brookfield Corporation's Q4 2025 press release, which includes reconciliations of these non-IFRS financial measures to their most directly comparable financial measures calculated and presented in accordance with IFRS.